Current tax revision, the effect of allowance for expected credit losses. The difference between the accounting and the tax treatment is that for accounting purposes, we will take the movement between the opening and the closing balance to profit or loss, whereas for tax purposes, we get a deduction on the balance, the SFP balance of the allowance for expected credit losses. Now, this percentage may either be at 25%, or it can also be at 40%. It may also be a combination of these two percentages, meaning some debtors might be included in our allowance for expected credit losses, and a deduction allowed for that at 25%, while for some debtors the allowance will be at 40%. So basically, if we look at our 4 GL accounts that we will have in our general ledger regarding debtors and allowance for expected credit losses and credit losses, first of all, we will have our gross debtors, which will always have a debit balance. Now, on the SFP, our allowance for expected credit losses will always have a credit balance, and these two accounts together will make up the trade debtors line item in the statement of financial position. So the allowance for expected credit losses is almost like the accumulated depreciation for PPE. Okay, then the movement for the allowance for expected credit losses to P&L will be either an expense or an income, depending on what that movement is. So if the allowance for expected credit losses balance went up, so it had a higher credit balance at the end of the year than at the beginning, that means my movement will actually be a debit, so that will be an expense. If the allowance for expected credit losses went down, it will give me an income amount on the movement on the allowance for expected credit losses. And then obviously we also have our credit losses. So these are real, actual credit losses that have realized. So in our current tax calc, what's going to happen is included in our accounting profit will be these P&L items that we have here, these two accounts. So first of all, the movement in the allowance, that will either be an income or an expense, or in this case, an expense or an income. Whereas my credit losses will always be an expense, and that will be included in our accounting profit already. So for tax purposes, what we now have to do is we first of all have to eliminate the accounting movement for the allowance. So here we are eliminating the accounting movement for the allowance to get rid of it. The credit losses amount stays there because we want that deduction. For tax purposes, we get the deduction for our total credit losses, our actual credit losses. But then for the allowance, what happens now is we have to deduct 25% of our closing balance, but we have to add back 25% of our opening balance to get to our taxable income at the end of the year. So for example, let's say in year 1, we had 2 debtors, a pink debtor and a purple debtor. Now, at the end of year 1, we are a little bit worried about our pink debtor, so we create an allowance for expected credit losses for this debtor. So in order to create this allowance, we have to credit the allowance for expected credit losses and debit the movement of the allowance for expected credit losses. Now, please note, I'm using very weird acronyms and abbreviations here. Please don't do that if I ask you to do general ledger accounts in a test or exam, unless you give me a key to all your abbreviations or acronyms that you have used. Anyway, okay, so now we have accounted for this pink debtor. We are worried about this debtor, so we created the allowance for expected credit losses. So what happens for this, for the allowance, is that we are effectively expensing 100% of this debtor in year 1 for accounting purposes. Now, what happens for tax purposes? For tax purposes, we will only be allowed to deduct 25% of our SFP balance for allowance of expected credit losses in the current year, and we will have to add back the deduction that we got last year, so 25% of the prior year. Now in this case, our prior year allowance for expected credit losses was 0, so there were no deductions in the prior year. Then also for tax purposes, or what effectively then happens for tax purposes, is that we are deducting 25% of our expected credit losses in year 1. Okay, so let's also say, for example, that our purple data was giving us problems, and what we did is we actually wrote down the purple data completely straight to credit losses. So we credited the gross debtors to get rid of it. Now we don't take it to the allowance because it's not that we are a little bit worried about it. We know we got a letter from the lawyer saying that this data is now bad. So we credit the gross debtors and we throw it into the bin of credit losses in P&L. Now what happens for tax purposes is we get 100% deduction for any actual credit losses during the current year. Okay, so that means for tax and accounting, the treatment for credit losses is the same. We treat them the same. So in our current tax calc, what we'll have is included in our accounting profit. We will have our deduction of our pink data. So this is the movement in the allowance for expected credit losses. And we will have a deduction of our actual credit loss, the purple data, which is the R1,000 data in our credit losses. Okay, so these two amounts will both be deducted in order to calculate our accounting profit. So what we now need to do is, first of all, for our pink data, for our movement in the allowance for expected credit losses, we have to now go and eliminate the accounting treatment. So we have to add back the movement so that we actually eliminate this accounting treatment. And then we bring in the tax treatment, which is the deduction at 25% or 40%, depending on the information in your question. Now we can leave the purple data right here. We don't have to make any adjustments because the tax and the accounting treatment is the same. So in year 2, we start off with our pink data still sitting in our gross debtors account as a debit, and the credit sitting in our allowance for expected credit losses. So that will be our opening balances. Now what happens is we're right that this data is now a bad data. So in year 2, what happens is we write down this data to as a credit loss. So we clear the data in the SFP and we take it to the P&L as an expense. Now obviously we also have to get rid of this allowance for expected credit losses because the data does not exist anymore. So we debit the allowance for expected credit losses and credit the movement in the allowance for expected credit losses in P&L. So what effectively happens here is that for accounting purposes, we expense the full pink data in year 1, and 0% of it is expensed in year 2, because you can see that the net effect for P&L between these two accounts is 0. We've got a debit and a credit of the same amount. So the net effect in P&L is 0. And our SFP balances are also 0. We've cleared out this data completely from our books. Now what happens for tax purposes? For tax purposes, we get a deduction of a percentage, let's say 25% of our current year balance, closing balance for the allowance of expected credit losses, which in this case now is 0. So therefore the current year deduction will be 0. Then we have to add back the deduction that we got in the previous year, which was 25% of last year's closing balance, also this year's opening balance, that we have to add back. However, we also get 100% deduction of our actual credit losses. So here again, our tax and our accounting treatment is the same. Okay, so effectively what is happening? Effectively, for tax purposes, we got the 25% deduction in year 1, but in year 2, we are getting 100% deduction, and then we add back the 25%. So minus 100 plus 25% gives us a 75% deduction in year 2. So for tax purposes, these amounts in the allowance for expected credit losses are effectively deducted over 2 years, where for accounting purposes, it's deducted in 1 year. But in the end, the full 100% is deducted, so we only have a timing difference. If we look at our current tax calc, we'll see that in our accounting profit now, we have an expense as well as an income. So we have a minus and a plus in our accounting profit, so the net effect is 0. So first of all, what we do is for our allowance in expected credit losses, we eliminate the movement. So we had this income here. So this was an income amount of 100 Rand. There's our income amount of 100 Rand. We now eliminate that. Okay. And again, we can leave the deduction, the 100% deduction for our actual credit loss, because there we said that the tax and the accounting is the same. Okay, then we have to go and deduct 25% of our closing balance for our allowance, which is 0, and we have to add back the 25% deduction that we got last year. So effectively what is happening here we have the 100% deduction, here we are adding back 25%. So effectively for tax purposes in year 2, we are getting 75% deduction.